Hello friends, welcome back to our YouTube channel. If you like this video, please like, share and subscribe. I'll share our videos commanded by our experts, so let's begin.
Showcase. If you like, please like, share and subscribe. So let's begin our today's topic. Let's begin.
In enterprise tech, established incumbents rarely lose market dominance in months. But April 2026 data reveals a structural inversion of power, reordering the industry's hierarchy. This chart displays adoption data from RAMP's April 2026 AI Index, tracking paid subscriptions. In April, Anthropic officially surpassed OpenAI in business adoption. 34.4% of surveyed companies paid for Anthropic products, compared to 32.0% for OpenAI. The market reached a state of relative maturity, with over 50% of all tracked businesses now maintaining at least one paid AI subscription. Exactly 1 year prior to this data release, Anthropic held a mere 9% of the enterprise user share. These volume bars represent annualized revenue run rate. Anthropic's surge in corporate adoption translates to a run rate of $30 billion. OpenAI's corresponding run rate stalled between $24 and $25 billion. A minority player with a 9% market share forced a $30 billion market inversion against an entrenched incumbent in exactly 1 year. They achieved this by executing a deliberate pivot away from horizontal API delivery toward deep vertical integration, prioritizing workflow placement over raw model intelligence. Anthropic ultimately secured the enterprise space by altering the structural architecture of how AI systems interface with daily corporate workflows. To trace the origin of this inversion, we have to examine the earliest leading indicator, the developer software layer. The primary catalyst was Claude Code, a dedicated AI coding assistant that Anthropic utilized to establish a foothold in the enterprise space. This tree map tracks the AI developer tool market over 10 months following Claude Code's launch. The expansion rate is entirely disproportionate to normal adoption curves. By the end of those 10 months, Claude Code captured over 50% of the entire developer tool sector. This represents a massive execution of bottom-up adoption, a strategy where a product is adopted by end users first, rather than being mandated by management. By targeting engineers directly, Anthropic bypassed the slow, bureaucratic C-suite sales cycles, where incumbents typically focus their energy. At the codebase level, when an AI assistant integrates into daily engineering tasks, it becomes a critical workflow dependency for the individual developer. Once hundreds of developers within a single corporation are using a tool daily, enterprise-wide procurement becomes a necessity for legal and security teams to maintain compliance. Capturing the developer layer generates significant revenue, but individual coding assistant licenses do not aggregate to a $30 billion run rate on their own. Claude Code secured the initial user permissions and internal security clearances required to pursue the higher-value contracts located deeper inside the corporate structure. The majority of Anthropic's $30 billion scale originates from high-spending sectors such as global finance, advanced technology development, and professional legal services. Historically, AI companies served these clients using a model-as-a-service or MaaS architecture. This standard model-as-a-service architecture sends data packets out of a local network across the internet to a remote server. In finance, this hits a roadblock. Strict data sovereignty laws prohibit sensitive data from leaving the local network to hit external endpoints. Furthermore, generalized remote models cannot easily parse the heavily siloed proprietary data lakes these corporations use. High-value enterprises demand sub-millisecond local latency controls and deep custom fine-tuning. Standard off-the-shelf remote APIs are structurally incapable of providing either. To solve this, Anthropic shifted from being a software provider to an active systems integrator. Anthropic recognized that the remote API model was inadequate for enterprise whales, forcing them to physically bridge the gap between their models and the client's internal data. Anthropic's structural solution was the formation of a massive enterprise consulting venture. Backed by $1.5 billion, this venture partnered Anthropic with financial firms Blackstone, Goldman Sachs, and Hellman & Friedman. This $1.5 billion serves as an operational deployment vehicle rather than a standard capital investment round. Anthropic's primary deployment tactic through this venture is the practice of embedded engineering. This mechanism allows Anthropic to place its own engineers physically inside the isolated, highly secure networks of these financial institutions. These embedded engineers serve as a real-time translation layer between Anthropic's technology and the bank's complex workflows. Operating within the corporate network, these engineers wire highly bespoke versions of Claude models directly into the local proprietary data lakes. This direct internal wiring reduces latency and keeps sensitive processing entirely behind the corporate firewall, ensuring adherence to data sovereignty laws. This strategy creates significant switching costs, the financial and operational burden a company endures when changing vendors. When an AI system is vertically integrated into a bank's core infrastructure, replacing it with a competitor's model becomes an operationally complex and costly endeavor. That deep integration is the bedrock of the $30 billion run rate. It guarantees long-term, stable revenue. The $1.5 billion consulting venture creates deep architectural dependency, converting plug-and-play artificial intelligence into vital, high-switching cost corporate infrastructure. Looking back at the April 2026 RAMP index data, the 34.4% versus 32.3% metrics represent more than a simple adoption flip. The statistical shift is a lagging indicator of a major architectural victory. Anthropic captured the enterprise market because they solved the last-mile deployment problem for high-value clients. When tested against corporate requirements, the horizontal API platform lost to the vertically integrated workflow partner. The playbook required two actions: capturing the developers first to create a wedge, and deploying embedded engineers to create structural dependency. For SaaS strategists, the lesson is clear. Offering a mathematically capable foundation model is no longer enough to guarantee market dominance. The future of the enterprise AI sector belongs to the companies that integrate deepest into the client workflow, not just those who compute the fastest. Anthropic's $30 billion run rate proves that in the enterprise market, structural proximity will always defeat isolated intelligence. For years, the enterprise AI market operated under a single core assumption. OpenAI held a permanent, unshakable lead. That assumption was based on historical momentum, until fintech company Ramp released its April 2026 AI Index. The data revealed a sudden reversal in paid business adoption. 34.4% of surveyed companies now pay for Anthropic products, while OpenAI's share slipped to 32.3%. The speed of this climb is significant. Anthropic's enterprise footprint stood at only 9% 12 months earlier. This adoption flip correlates with a massive revenue surge. Anthropic reached an annualized revenue run rate of $30 billion in April, moving past OpenAI's estimated $24 to $25 billion range. This shift occurred within a saturated market, where over half of all tracked businesses, 50.6%, already maintain at least one paid AI subscription. This wasn't a result of Anthropic building a slightly more capable general-purpose chatbot. The growth was driven by a specific move toward hyper-specialized developer tools and the direct embedding of engineers into client workflows. These metrics suggest that in the current market, maintaining a lead requires a model that moves beyond conversation and into the underlying architecture of a business. The primary tool behind this surge is Claude Code, Anthropic's dedicated coding assistant. Within 10 months, Claude Code captured more than 50% of the AI developer tool market. Standard AI coding tools typically require high friction. Developers manually copy code and switch contexts between their editor and a separate web interface. Anthropic targeted this friction by building what engineers call a hyper-perceptive environment. In this setup, the AI maintains a passive, constant awareness of the entire proprietary codebase. It understands the project structure without manual inputs. This removes the need for zero-shot prompting, where a developer is forced to repeatedly explain the same code to the model to get a useful response. Integrating directly into the command line allows engineers to ship code with significantly fewer interruptions. These productivity gains led developers to bypass traditional software channels, pressuring their IT departments to secure Anthropic licenses to keep up with internal demand. Ultimately, the tool that offers the least cognitive resistance for engineers is the one that dictates a company's broader procurement strategy. While developer adoption provided the volume, the financial scale of this shift came from capturing sectors with massive spending power. Anthropic focused its expansion on finance, technology, and professional services. These industries are traditionally risk-averse. they often avoid generalized AI models because of strict regulatory requirements and the need to keep proprietary data behind firewalls. In these sectors, generation speed matters less than the security and compliance of the integration itself. Anthropic designed its enterprise architecture to run entirely within a company's closed tech stack. This allows the AI to function without making external web calls that could trigger security alerts. When an AI tool can actively prevent compliance breaches during the deployment phase, it becomes a critical security asset rather than just a writing aid. This high-security approach allowed Anthropic to charge premium subscription rates, inaccessible to generalized consumer models. These premium contracts in high finance and tech propelled the company to its $30 billion run rate. Anthropic secured the most lucrative data environments by prioritizing privacy over broad consumer appeal. Most software-as-a-service providers face a constant threat. High switching costs are often an illusion. If a tool is just an API call, a company can swap it for a cheaper competitor in a single afternoon. Anthropic addressed this by launching a $1.5 billion enterprise consulting venture. To fund and legitimize the venture, they partnered with Blackstone, Goldman Sachs, and Hellman & Friedman. This represents a move toward vertical integration, controlling the implementation as well as the software. Anthropic is now deploying its own staff engineers to work directly inside client offices. These engineers work to hardwire Claude Code into the company's bespoke, legacy workflows. Once the AI is woven into the core infrastructure, removing it becomes a massive operational risk. Anthropic has created a model where staying with their service is far more practical than the expensive process of tearing out a deeply integrated system. The $30 billion run rate was built on these three pillars: dominating developer tools, capturing high-security sectors, and embedding engineers directly into the workforce. This shift suggests that simply providing access to a high-end model is no longer enough to maintain an enterprise lead. Long-term value is now found at the workflow level, where the AI is inseparable from the way the business functions. This new paradigm places OpenAI in a difficult position as they prepare for their own financial milestones. The central challenge for OpenAI is how to justify a massive IPO valuation when their primary competitor has already integrated itself into the highest-paying enterprise clients. The next stage of the AI market won't be defined by who has the smartest model, but by who becomes the most difficult to remove.